As a lifelong learner, I have recently begun the exciting journey of learning how to day trade. My initiation into this world began with the discovery of a highly recommended book titled How to Day Trade for a Living by Andrew Aziz. This book serves as a comprehensive beginner's guide, delving into essential aspects such as trading tools, tactics, money management, discipline, and the psychological aspects of trading. This video attempts to ingrain the lessons I learned from this resource in a way that allows me to teach it, which is the ultimate way to suggest you've learned the material. While my primary focus is on teaching myself, I hope you find value in the video. Trading is a challenging endeavor, not a get-rich-quick scheme. Active trading involves real money and requires discipline and preparation to avoid negative consequences. Earning a living as a day trader can be quite lucrative. On average, a skilled day trader can make between $500 to $1,000 daily, which adds up to an annual salary ranging from $120,000 to $240,000. It's worth noting that professionals such as doctors, lawyers, and engineers undergo extensive training to earn a similar income, so it's a challenging task. However, the rewards of such a salary make it worth the effort, and many people opt for this profession as it offers a unique lifestyle. As an inquisitive person, I am naturally drawn to research, reading, writing, and creating. Day trading is an excellent option since I can work a few hours, enjoy the rest of the day off, or even take whole days off whenever I want. It allows you to redeem the time. In day trading, traders look for stocks that move predictably to trade within a day. Holding stocks overnight constitutes swing trading. Swing trading typically involves holding a stock for a period ranging from one day to a few weeks. It's important to note that the rules for day trading and swing trading are distinct and must not be combined. As a day trader, you must close all your positions before the market closes. The stock picks for swing trading and day trading differ significantly. Swing traders seek stocks in stable companies that won't cause significant losses if held overnight. It's worth noting that day trading stock picks can be risky as they involve buying and selling stocks within the same day. These picks could include companies on the verge of bankruptcy, which day traders may not care about as they only focus on short-term gains. In many cases, day traders may sell their stocks at a loss just to avoid holding them overnight. When day traders purchase a stock hoping the price will increase, it is known as buying long or going long. In a long position, day traders aim to sell the stock at a higher price to make a profit. Buying long is a favorable strategy when the stock price is expected to rise. If the prices of shares are decreasing, you can sell short. Day traders typically borrow shares from their broker, sell them, and hope the prices keep slipping so they can repurchase the shares at a lower price and profit. This is known as selling short or going short. However, if the stock price goes up instead of down, the investor may have to repurchase the shares at a higher price, resulting in a loss. For short sellers to make a profit, the stock price must decrease. This strategy is essential for day traders because stocks tend to drop in price faster than they rise. Short selling can be profitable if done correctly and with emotional control. However, fear can lead to panic and the selling off of shares. It's important to note that brokers charge interest on the borrowed shares when short selling, which means you will need to pay interest on the shares you borrow. You typically won't have to pay interest if you short sell within the same day. However, you will be charged interest daily if you hold short positions overnight. Due to the potential risks and complexity of short selling, many day traders prefer to focus on long positions. You should always be willing to short sell to avoid missing out on opportunities, but it's essential to be extra cautious and mitigate the risks as much as possible. Let's talk about the distinction between retail and institutional traders. Retail traders are individuals like you and me, regardless of whether we work part-time or full-time. Unless we work for a company where we manage other people's money, we are retail traders, which make up a small portion of the market volume. On the other hand, institutional traders are banks, trading firms, and mutual and hedge funds that trade using complex algorithms and high-frequency trading strategies. Despite the perception that institutional traders have an advantage, retail traders have a significant edge over them. Institutions often have to trade in large volumes regardless of the price, but as a retail trader, you have the advantage of being patient and waiting for the proper setups. It is not necessary to overtrade. Instead, exercise self-discipline, have patience, and wait for the right opportunities to come your way. It's not about outsmarting the institutions, but waiting for an opportunity to reach your daily profit targets. The other advantage you have as a retail trader is that you can exit losing trades quickly. As a new trader, you should start with at most one standard lot or 100 shares. The rewards may be low starting out, but it's also low risk, which is an excellent place to be as a beginner. Remember, trading is not a get-rich-quick scheme. Take the time to master the fundamentals, the discipline, and the psychology it takes to be successful. Because of the large volume institutional traders trade in, it may take some time to exit a prominent position, causing significant losses. Take advantage of your nimbleness as a day trader and cut your losses when a stock trades against your exit price. Day traders profit from the volatility in the market, which occurs in morning trading more often than later in the day. When the market and stock prices are moving less, you're typically only going to make money if you're a high-frequency trader like an institution. Stay away from stocks that are being heavily traded by institutional traders. Trade only in stocks that other retail traders are trading and seeing. Many day traders are happy to share their day trading strategies because the more buyers, the quicker a stock increases. As a day trader, you're hunting for stocks in play. Most stocks will trend with the overall market unless they have a reason not to due to some catalyst. And these are the small handful of stocks that will soar when the markets are crashing and vice versa. If these stocks are flying with the market, it's okay if they have a fundamental reason to move outside the overall market trend. Stocks in play usually have unexpected fresh news, regardless of whether it's positive or negative. For example, earnings reports, earnings warnings or pre-announcements, earnings surprises, FDA approvals or disapprovals, mergers or acquisitions, alliances, partnerships, or significant product releases, major contract wins or losses, restructurings, layoffs, or management changes, stock splits, buybacks, or debt offerings, etc. A good day trader always asks if the stock is moving because of the overall market or if a fundamental catalyst exists. In the beginning, you'll have to research, but as you become more seasoned, you'll be able to differentiate between stimulus-based price action and general market trends. Trade where other retail traders are trading, and you'll avoid being on the wrong side of a transaction against institutional traders. Focus on the stock moving daily and receiving a ton of action because that is what day traders will look at. You can trade the big stocks like Facebook, Apple, and the like, but they're slow-moving and dominated by institutional traders. A couple of ways to find your focus are using day trading stock scanners and joining a community of day traders. These are good places to get a pulse on what's trending. You'll make it harder on yourself if you're isolated. Most day traders don't trade penny stocks or on the over-the-counter market. Instead, they focus on commodities, currencies, and especially equities in the morning. From about 9:30 a.m. to 11:30 a.m., New York time is when the market will have the most trading volume and volatility, which is the best time to trade. High trading volume provides liquidity, one of the most important aspects of trading. High liquidity means plenty of buyers and sellers, which allows you to get in and out of trades without worrying whether or not your orders will get filled. from midday until about 3 in the afternoon. You're looking at low trading volume and a lack of liquidity, which impairs trading substantial shares. In addition, low trading volume means you could end up on the wrong side of a trade with institutional or algorithmic traders. Ideally, it's better to trade within the first 2 to 3 hours of the market's opening, making sure to get out of all trades by noon. After that, your time is yours. But a good day trader will take the time to review and journal trades to track winners, losers, and why. Success in day trading results from 3 skills: learning and mastering one or a few proven trading strategies, proper risk management or knowing how much of a size to enter a trade and knowing when to exit, and having a sound psychology. Additionally, good nutrition and adequate sleep are also important. A common reason beginning day traders fail is the inability to manage their early losses. The common temptation is waiting for losing trades to bounce back to a break-even point, damaging your account. You have to go in with firmly embedded risk management rules. And even more, you must firmly execute those rules daily. Have your lines drawn in the sand on every trade that dictates when you leave. This is widely known as a stop loss. Be honest with yourself and admit promptly when trades do not work. Stick to your guns or get blown away by the market. It's better to accept the loss and be able to return to trade at a later time than to double down on a losing trade. Every time you enter a trade, you want to mitigate risk by finding a good setup, managing the risk with proper share size, and implementing a stop loss. Succeeding in day trading comes from finding low-risk entry points and high potential rewards. The minimum setup you should aim for is a 2-to-1 win-lose ratio. For example, you risk $100 for the potential of making $200. There's an upside to that ratio, unlike risking $100 to make $50, which is less than a 1-to-2 ratio and a risk you shouldn't entertain. It's an unfavorable risk-reward ratio in which you stand to gain less than you risk. Good day traders will not entertain trades with less than 2-to-1 profit-loss ratio. If you buy $1,000 worth of stock for $100, you should expect to make $1,200 or at least $200. If the price drops $100, you should exit with a loss of $100. Identifying setups with proper risk-reward ratios is integral to the learning process. Using a 2-to-1 ratio, you can be wrong 40% of the time and still make money. As a day trader, remember your job is to manage risk, not buy and sell stocks. There are 3 steps to follow. Am I trading the right stock? Avoid stocks traded heavily by computers, have low trading volume, are penny stocks, and are easily manipulated, with no fundamental catalysts. What share size should I take? This depends on your account and daily profit goals. What is my stop loss? An easy way to determine your stop loss is to never risk more than 2% of your account and stick to it. Here's a look at risk management in 3 steps. Step 1. Calculate the maximum dollar you're willing to risk on a trade, remembering to never trade more than 2% of your account. Step 2. Estimate max risk per share, the stop loss, in dollars from your entry. Step 3. Divide 1 by 2 to find the maximum number of shares you can trade each time. A fundamental reason traders fail is that they take adverse events and losses personally, or their confidence and peace of mind are connected to their trading results. Successful traders trade for skill, not money, with many professionals hiding their unrealized profit and loss column while in a trade. It's about executing the perfect profit target or stop loss level. Every trade for good day traders, positive or negative, is an opportunity to improve themselves. Day trading requires quick decisions with discipline, so it's a demanding career. But anything worthwhile will be demanding. It's an opportunity to master a new skill and your mind. The challenge of learning a new skill and mastering my mind is part of my attraction. The other is lifestyle. Day trading is an earnest pursuit and should be treated as such. Trading is based on probabilities, requiring patience to identify setups with attractive risk-reward potential. Learn to accept your losses in a simulator and only move to live trading when you have mastered accepting and respecting your stop loss. A good trading day is one where you are disciplined and follow your trading rules, not one where you make a profit. Many new traders need to learn what a good stock to day trade is and how to find one. You can only make money consistently if the stock you pick moves or has enough volume. You need to identify stocks that are about to move in a specific direction. Some stocks may move too much intraday and never foreshadow their direction. Your goal as a newcomer is to get skilled at finding stocks in play. All the strategies in the world will only save you if you're in the right stock. There are many ways to select stocks in play and make money trading them. For some traders, it's indexes. For others, it's exchange-traded funds or ETFs. And for others, it's futures. Professional traders who work the trading desks at companies focus on sectors like gold or tech. You'll develop your style with time and experience, but you must select more efficiently as retail traders with limited capital. A stock in play offers more reward opportunity than risk. You want more upside potential than downside possibility. A stock in play displays movement predictable, frequent, and catchable by the trader. Trading stocks in play also helps you against the machine and its swaths of algorithmic programs. So what are they? They are stocks with fresh news, a stock that is up or down more than 2% pre-market open, unusual pre-market trading activity, and/or stock that develops critical intraday levels you can trade from ultimately. The stock should have high relative volume, but be careful because high volume will be relative from one stock to another. For example, Facebook trades in high volume, but it's also a mega cap stock, which often trades in high volume. You must look for what's above average or unusual for that specific stock. If it's not higher than usual, trading is dominated by institutional traders and bots. This is a no-trade zone, a bot mission when stocks are trading normally. The characteristic you're looking for with high relative volume is that the stock trades independently of its sector and the overall market, which means it has a fundamental catalyst. When the market is weak, most stocks are selling off regardless of the ticker symbol and sector. When the market is strong, most stock prices are rising higher. Likewise, when you hear the term bear related to the market, it means the market is weak, and bull implies the market is strong. The same can be valid for specific sectors. You can recognize the behavior of the market by looking at index funds such as the Dow Jones Industrial Average, ticker DIA, or the SPDR/S&P 500 ETF Trust, ticker SPY, which are good indicators of how the overall market is doing. If either one is in the red, you have a weak market, and vice versa if either one is green. Again, stocks with high relative volume operating independently of the overall market are considered stocks in play. Every day, a handful of stocks are traded independently of their sector and general market. Day traders trade only those stocks. How much volume is enough? Anything less than a daily volume of 500,000 shares is probably not worth your time. You need liquidity in the stock, which affects your ability to get in and out of a stock without difficulty. The lower the volume, the more difficult. You may attempt to exit at a specific price point, but because the volume is low, you may have to sell at a lower number, which could throw a monkey wrench in your initial strategy. In addition to volume, remember stocks in play have a fundamental catalyst such as earnings reports, earnings, warnings, pre-announcements, earnings surprises, FDA approvals or disapprovals, mergers or acquisitions. You get the point. You're looking for anything newsworthy attached to the stock. Check the news on all stocks up or down more than 2% pre-market and create a short watch list of 2 to 3. Stocks in play the day before are often still in play for a few days. You can categorize stocks in play into 3 classes, which helps clarify how to find and strategize for them. Let's begin with float and market cap. Float is the number of shares available for trading. Mega cap stocks like Apple could have billions of shares in the market available for buying and selling. These stocks typically move very little because it takes a significant volume and money to be traded, which means they're not very volatile and unsuitable for day traders who require volatility. Conversely, companies with a low float in the millions could suddenly have a significant demand, which would quickly move the stock price. Most low-float stocks are under $10 because they are early-stage companies that may not yet be profitable. These low-float stocks are also called small or micro-cap stocks. As a day trader, these are the stocks you love. The first category consists of low-float stocks priced under $10. They tend to be highly volatile, moving 10, 20, 100, or even 1,000% each day. You must be careful because low-float stocks are often highly manipulated and challenging to trade. Only seasoned, battle-tested good day traders should trade these stocks. But the bull flag momentum strategy works best for low-float momentum stocks. There are many strategies out there, and with time, you'll develop your own. What works for others might not work for you. This journey, should you take it, is just as much about learning yourself as it is about strategy. And for many, that is the strategy to beat your body and make it your slave. Discipline your mind. Generally, you cannot sell short low-float stocks priced under $10 because a broker rarely will lend shares for such volatile stocks. You can still become a full-time profitable trader without the unnecessary risks of short selling these types of stock, because they're so difficult to read, which hampers your ability to manage risk. New traders are advised to steer clear of them. The second category is medium float stocks ranging in price from $10 to $100. Their floats range from 20 to 500 million shares. This category is open to many more strategies for the trader, such as volume-weighted average price and support or resistance strategies. Medium float stocks of more than $100 are not popular among day traders because of their expensive price. It limits the number of shares you can purchase, making it useless to day trade them. The third category of stocks is mega cap, which typically has more than 500 million in float. They tend to move only when institutional traders and the titans in the machine are buying and selling them. Day traders who trade at most a couple thousand shares cannot move the needle on these stocks, and so they are stocks you should avoid unless there is a fundamental catalyst for them. Reversals and moving average strategies work well on these stocks, but only when they are in play. Stocks in play can be found in 2 ways: pre-market morning watch list and real-time intraday scans. Once you have a scanner, here are the criteria you can plug in to help find stocks in play. Stocks in pre-market gapped up or down at least 2%, traded at least 50,000 pre-market shares, average daily volume of over 500,000, and stocks with an ATR or average true range of 50 cents. A fundamental catalyst should be present, and as a rule, you should not trade a stock with a short interest higher than 30%. When a stock trades a minimum of 50,000 shares pre-market, it's usually a good indicator that a catalyst is present. From the short list of stocks you find pre-market that have gapped up or down at least 2%, you want to go over each of them before the market opens. Check the news on them and learn the catalyst, if there is one. From your list, you want to select the top 2 or 3 that you'll add to your watch list. You'll watch these on your screen and look for potential setups. You want to plan your trades before the market opens. Sometimes, you won't be able to identify a stock in play on a gapper scanner pre-market. If that's the case, Revert to your intraday real-time scanner to find stocks in play for momentum, reversal strategies, or another type of trade suitable during trading hours. Using a volume radar scanner intraday, you can plug in the following criteria for stocks in play. A stock that has gapped up or down at least $1, a TR of more than 50 cents, a minimum average relative volume of 1.5, which suggests the stock is trading at 1.5 times its normal volume, and again an average daily trading volume of 500,000 shares or more. It's also good to look at the sector the stocks fall into. The stock is probably not in play if a few are in one industry. For the momentum strategy, you need to find moving low-float stocks. It's easier to find these stocks with a good scanner. Top and bottom reversals are additional strategies for which you cannot find stocks in the pre-market. You need an excellent intraday real-time scanner. Scanners are tools of the trade and can be pricey, raising the barrier to entry. New traders may not need one. Some communities allow you to observe their real-time scanners, and some brokerages offer scanners. If the brokerage scanner doesn't perform how you need it to, you should get your own so you're not relying on the community. I would also wait until you have learned all the fundamentals of trading, including the psychology. Some scanners may offer trials, which you could use for practice in the simulator, but I would hold off deploying any money until you're ready to go live. Once again, keep in mind that a lot of the strategies discussed are what works for the author. Experience may lead you to set up your scanners differently and adopt new methods, but you must start somewhere. Once again, the focus should be on quality versus quantity. Select your 3 stocks in play and monitor their charts separately on 3 screens. When you see a potential strategy, plan your trade. You may be forced to prepare in minutes or just a few seconds. This is another reason you should have months of training in a simulator to thoroughly understand the decision-making process. It's essential to be disciplined and patient to wait for only the opportunities worth trading. The key is to be able to jump in, take your profit, and jump out. How do you buy and sell stocks? You need a broker or brokerage account which acts as an intermediary between you and the stock exchange. You need a direct access broker for day trading. Your broker is responsible for filling your order on time and at a reasonable price. 2 things that can make or break a day trader. Regarding brokers, let's talk about the pattern day trade rule. This is the rule set by the U.S. Securities Exchange Commission and the Financial Industry Regulatory Authority, which enforces laws limiting the number of trades a trader can make if undercapitalized. The rules adopt the term pattern day trader, which includes any person who day trades, buys and then sells or sells short and buys the same security on the same day, 4 or more times in 5 business days. Under the rules, a pattern day trader must maintain a minimum equity of $25,000 on any trading day. If it falls below that threshold, the day trader will be permitted to day trade again once their account is restored to the minimum equity level. The rule is in place to protect amateur traders from losing their limited capital to brokers' high fees and commissions. Regardless, it deters many new would-be traders from pursuing this line of work. Aspiring day traders should check with their brokerage for restrictions, but within the US, the rule is strictly enforced. Offshore brokers are not subject to the rule, but many do not accept clients within the United States. If you use a broker outside the US, you are also not protected by the same safeguards enforced by US authorities. Some traders use offshore brokers and recommend that you withdraw regularly until you can open a US account. There are 2 kinds of brokers: conventional and direct access brokers. Traditional brokers emphasize research and analysis functions more than speed and execution. Trades go through a multi-layered process, adding a few seconds to several minutes to every order. Conventional brokers are great for investors, but not so much for day traders who live by the speed and execution of each trade for entry and exit. Direct access brokers, on the other hand, focus their services on speed and order execution, allowing traders to trade directly with the stock exchanges, in many cases via electronic communication networks. However, some DABs have volume and technical knowledge requirements, going as far as to charge for inactivity if a minimum monthly trading metric still needs to be met. Thankfully, not all share this requirement, so it will take some due diligence on your part to find those who don't and choose the best one. The technical part can be learned by practicing in your broker's simulator and getting comfortable before placing any live trades. Another thing to consider is the leverage your broker offers. Some offer 3 to 6 times leverage on whatever you put in. Your $25,000 could go to $150,000. The leverage is called margin, and while it's nice to have, you need to be careful with it. An opportunity to buy more exposes you to more risk. If you're using leverage and losing money, your broker might issue a margin call, meaning your loss now equals your account. Your broker will freeze you out of your account until you add more money. Avoid margin calls as a day trader. Your buying power is your capital plus leverage offered by your broker. If you lack the necessary funds starting out, another route is prop firms or proprietary trading firms. Prop firms provide traders capital, services, tools, training, and mentorship to find success in trading. They also share in the profits with traders. You have to pass their consistency criteria to become eligible, which may require a small fee depending on how much capital you're looking for. An excellent way to look at it is a fee to take state exams to become certified in ABC trade. If you pass, you get your certification and can work in that designated trade. You pay a fee with prop firms to take their tests, and if you pass, you get capital to work as a trader and pocket most of the profits. It's a great way to get your foot in the door. Many traders have gone this route. It has also taken many of them several times to pass the required tests, but persistence and dedication got them through the door. Outside of a good broker, you need a good trading platform. Although many brokers offer their own, they are two separate things, and a good broker only sometimes equals a good trading platform. You'll need to consider trading fees from your broker and monthly payments depending on your choice of trading platform. Once again, both are important because, as a day trader, speed and precise execution are crucial to success. For example, you need hotkeys with whatever trading platform you're on. Hotkeys are commands you can create and assign to a combination of keys on a keyboard to remove the friction associated with a mouse, trackpad, and manual entry of a particular trade. Those eat away at critical seconds and potential profits, so day traders use hotkeys. It would be prudent for you to practice in a simulator for months and master your hotkeys. Some traders also prefer keyboards that plug into the computer over anything battery-powered, citing batteries die. They also keep spare keyboards ready to go if the first gets damaged, etc. Trading is serious business, and preparation is critical. Depending on your day trading market, you'll also need real-time intraday data for that specific market, which is not free. You'll need to pay your broker or trading platform for access. Trading in the US requires the real-time Nasdaq TotalView Level 2 data feed. Level 2 provides insight into a stock price action, including the type of traders buying or selling a stock and where the stock is likely to head soon. Level 2 is also a leading indicator, showing activity before a trade happens. Moving averages, charts, and most other indicators are lagging indicators, which give insight after a trade is placed. With leading insight, day traders can know who is interested in a stock, which can be extremely useful. When the market is open, there are two prices for any stock. There's a bid, which is what people are offering to pay for that particular stock, and there's an ask, which is what sellers demand to sell. The bid is always lower than the ask. The difference is termed bid-ask spreads. Bid-ask spreads vary for each stock and the same stock, depending on the time of day. Spreads are higher in lower volume traded stocks because the market makers who control such stocks demand higher fees from those who want in on the action. This is important when you enter and exit a trade. There are 3 types of orders to place a trade. There are market orders that execute trades and sell at any price now. Execution at any cost is potentially hazardous to your strategies. A market order buys and sells at the asking price, and prices can change quick, especially in a volatile market. Market orders are never a good idea. Limit orders allow you to specify the maximum and minimum price you will accept. The issue with limit orders you may run into is the off chance your order might not get filled. There's also a flexible or marketable limit order, which buys and sells at the price you specify with some leeway you designate. For example, you can select $10.50 plus 5 cents and not any higher, or $10.50 minus 5 cents and not any lower. Seasoned day traders use this option to help ensure their order gets filled immediately. Although the marketable limit order on the bid price is the best route to take when placing orders, there is what is known as an SSR when it doesn't work. An SSR means selling restriction mode, triggered when a stock is down 10% or more from the previous day's closing price. Exchanges restrict short selling of a stock when the price is dropping. You can only sell short on the ask side. The sellers who hold positions receive priority over those wanting to profit from the downward movement. If you're going to sell short, you must get in line with the asking price and wait for buyers to come to you. Sellers holding positions can accept bids from buyers. Day trading requires you to process information quickly, so keeping things clean and with limited distraction is a good idea. Limiting your indicators and the number of colors is a good idea to remain organized. Price action in the form of candlesticks, the volume of shares being traded, 9 exponential moving averages, 20 exponential moving averages, 50 simple moving averages, 200 simple moving averages, volume weighted average price, previous day's closing price, and daily levels of support or resistance are indicators used by the author. All are calculated by a trading platform except for support and resistance, which the trader manually calculates before market opening. The indicators are not set in stone. You may develop different strategies and, in turn, other indicators as you gain more experience. Some traders recommend joining a chat room because of the mental toll the market can take on you if you're trading alone. It's an opportunity to build camaraderie and learn from seasoned traders, including when they lose, so that you're reminded it happens to the best of them. The potential con with being in a community, especially as a beginner, might be the tendency to follow what the crowd is doing. Your goal is to develop your own playbook, which is difficult if you are swayed back and forth between other traders' strategies. It's important to note that methods don't guarantee green. They exist only for a higher probability of green. Additionally, some chat rooms come with a price tag. Mastering the fundamentals and practicing in the simulator until you have a good grasp on trading and identifying your setups. When you're ready to go live and feel the need for a community, you can always find one at that time.